points to 3.75%. This is the sixth consecutive increase since March. We also expect our policy interest rate will need to rise further. How much further will depend on how monetary policy is working to slow demand, how supply challenges are resolving, and how inflation and inflation expectations are responding to this tightening cycle. La décision de la semaine passée reflète plusieurs.
Our decision reflected several considerations. First, inflation in Canada remains high and broad-based, reflecting large increases in both goods and services prices. Inflation has come down in recent months, but we've yet to see a generalized decline in price pressures. Second, and related, the economy is still in excess demand. It's overheated. Job vacancies have declined from their peak, but remain high. And businesses continue to report widespread labor shortages. Third, higher interest rates are beginning to weigh on growth. This is increasingly evident in interest rate-sensitive parts of the economy like housing and spending on big-ticket items. But the effects of higher rates will take time to spread through the economy. Fourth, there are no easy outs to restoring price stability. We need the economy to slow down to rebalance demand and supply and relieve price pressures. We expect growth will stall in the next few quarters. In other words, growth will be close to zero. But once we get through this slowdown, growth will pick up. Our economy will grow solidly, and the benefits of low and predictable inflation will be restored. To put this in numbers, growth in gross domestic product, GDP, is projected to decline from about 3.25% this year to just under 1% next year, and then rise to 2% in 2024. And inflation is expected to hover around 7% in the final quarter of this year, fall to around 3% by the end of next year, and return to the 2% target by the end of 2024. Finally, we are trying to balance the risks of over and under tightening.
Continue to endure the hardship of high inflation. And they will come to expect persistently high inflation, which will require much higher interest rates and potentially a severe recession to control inflation. Nobody wants that. If we do too much, we could slow the economy more than needed, and we know that has harmful consequences for people's ability to service their debts, for their jobs, and for their businesses. This tightening phase will draw to a close. We're getting closer, but we're not there yet. I also want to update you on the bank's balance sheet, which has been declining as a result of quantitative tightening. The balance sheet peaked in March of 2021 at $575 billion, and as of last week, it was about $415 billion, which is a decline of about 28%. The decline primarily reflects the maturity of our repo operations and the reduction in our holdings of Government of Canada bonds following the decisions to end quantitative easing in October 2021 and begin quantitative tightening last April. After a period of above-average income, our net interest income is now turning negative. Following a period of losses, the Bank of Canada will return to positive net earnings. The size and duration of the losses will ultimately depend on a number of factors. These include, in particular, the path for interest rates, as well as the evolution of the economy and the balance sheet. The losses do not affect our ability to conduct monetary policy. I would also stress that our policy decisions are driven by our price and financial stability mandates. We don't make policy to maximize our income. The bank's job is to ensure that inflation is low, stable, and predictable, and we are still far from that goal. We view the risks around our forecast for inflation to be reasonably balanced, but with inflation so far above our target, we are particularly concerned about the upside risks. We are mindful that adjusting to higher interest rates is difficult for many Canadians. Many households have significant debt loads, and higher interest rates add to their burden. We don't want this transition to be more difficult than it has to be. But higher interest rates in the short term will bring inflation down in the long term. Canadians are looking for ways to protect themselves from rising prices, and we are working to protect them from entrenched inflation. It will take time to get back to solid growth with low inflation, but we will get there. By working through this difficult phase, we will get back to price stability with sustained economic growth, which benefits everyone. And with that summary, Senior Deputy Governor and I would be very pleased to take your questions.
Thank you, Governor Macklem, Senior Deputy Governor Rogers. As you can see, we have a full House. We have many members and eager to ask questions. We're going to move into our first round, and in that round, each party will have up to 6 minutes to ask questions. We're starting with the Conservatives. I have MP Hallan for 6 minutes, please.
Thank you, Chair, and thank you to the Governor and Senior Deputy Governor for being here. I'll get right into it. In a speech on October the 6th, Governor, you told the Halifax Chamber of Commerce, and I quote, "Inflation in Canada increasingly reflects what's happening in Canada," end quote. And in the lead up to that statement, Canada had already seen $110 billion in added to the debt before COVID, $500 billion just in the past 2 years, 40% of which we know had nothing to do with COVID or anything that was COVID related. Now there is $52.2 billion in new spending this year, according to the PBO. Would you agree all this spending is going to add more to fuel this homegrown inflation?
Well, let me say a couple things. First of all, you don't get to 8.1% inflation because of one thing. A whole number of things happened, and as I discussed in Halifax, the initial push to inflation was largely from global factors, higher goods prices, higher oil prices. But as you highlighted, increasingly, the inflation we see in Canada reflects what is happening in Canada. Our economy is in excess demand. It is overheated. Essentially, businesses can't produce as many goods and services as consumers want to buy, and so prices are going up. And why is the economy in excess demand? We went through the deepest recession in history. That was followed by the fastest recovery ever. And now we're on the other side of that. And yes, inflation is certainly too high, and we are committed to restoring price stability.
Considering that the fall economic statement and supplementary estimates B are both containing even more government spending, seeing as more spending is only going to drive up inflation, is the government counteracting the measures you and the bank are taking?
So with respect to government spending, look, governments, parliaments, those are decisions. Those are your decisions as parliamentarians. What we do at the Bank of Canada is we take into account the government's plans, the federal government's plans, the provincial government's plans. We build those into our projections, and then that feeds into our forecast for inflation, our outlook for inflation, and that is an important input into the interest rate decisions that we take. So the outlook that I gave you and that we published in our monetary policy report a few weeks ago reflects the spending plans of the government.
But Governor, would you agree that you have to change your projections as there's more spending by the government?
I would agree that we take those into account. There are many things going on in the economy. Government's decisions are one of those things, and we take those into account when we take our decisions. When governments add to...
So I'll just a small example. So if there's $52.2 billion in new spending, would you agree that you would have to increase your rate again?
Well, it depends what else is happening in the economy. Look, other things equal, as economists like to say, the more demand... First of all, government actions can have both demand and supply consequences. So, for example, the government has increased the target for the number of immigrants coming into the country. That's going to add supply, it's going to add workers, it's going to add new Canadians. It's also going to add demand because they're going to need housing, they're going to get incomes, they're going to spend them. So we are going to take both those into account. So yes, other things equal, the more demand in the economy there is, that means the higher interest rates would have to be to bring inflation back to target. Government policies have a range of effects, and we do our best to take those into account. We have a clear mandate, and we take our policy decisions in pursuit of our mandate.
Okay. Just changing gear, at a previous appearance at this committee, you noted that the carbon tax is inflationary, adding to homegrown inflation. The government will be increasing that on April the 1st, 2023, and eventually will triple it to $170 per ton by 2030. How will the increase in the tax increase its impact on inflation?
So in our monetary policy report, I don't have the number of the chart, but in our monetary policy report, there is a chart with our outlook for inflation. And in that, we break out the various pieces. So one of those pieces is the increases in the carbon tax. And there's, as you're well aware, there's a series of increases in the carbon tax. And roughly speaking, they add 0.1% to inflation in each of the years going forward.
So it would be inflationary, the higher it goes.
0.1%.
Yeah,
yes.
But it is inflationary in your opinion.
Adding 0.1%.
Okay. According to Statistics Canada, Canadians' debt-to-disposal income is now at 184%. As Canadians run out of money, you are continuing to raise interest rates as a result of homegrown inflation. 1 in 5 Canadians are skipping meals or cutting back on food. Almost 50% of Canadians say their finances are worse than a year ago. And half of variable mortgage holders have hit the trigger rate. How many Canadians will have to default on loans or miss mortgage payments or not be able to buy groceries before the bank considers the interest rate is too high?
Well, look, what I would highlight is we are acutely aware that high inflation is making life very difficult for Canadians. As you highlighted, Canadians they've been surprised by this rapid rise in their cost of living. And they are finding it, many Canadians are finding it very difficult.
What would be the trigger rate in your opinion?
To cover their bills.
Is there a trigger rate in your opinion?
That's the time, MP Hallan.
Right.
Thank you. And we are moving to the Liberals, MP Zarowitz, for 6 minutes, please.
Thank you so much, Mr. Chair. And I want to say thank you to you, Governor, and to Deputy Governor for being here today. And thanks for your outstanding work during these unprecedented times. You talked a little bit about this during your remarks at the front end. I want to talk to you about a negative equity position. So the Bank of Canada undertook extraordinary measures during the pandemic to put a floor under the Canadian economy and protect people and businesses. Some of these measures has arguably led to the potential of the bank entering a negative equity position very soon. What's your reaction to the concerns that have been raised in the press recently?
Well, in a second, I'm going to turn it to the senior deputy to respond to this in more detail. But as I underlined in my opening remarks, yes, we are, as a result of the actions we took, we undertook quantitative easing. In the first part of the crisis, that created extra income for the Bank of Canada. Now, as interest rates increase, we are starting to incur net interest rate losses. What I want to there are various solutions to that problem, and the Senior Deputy Governor is going to say a word about that in a second. But what I want to stress is that whatever solution is chosen, it's not going to affect how we run monetary policy. We, as a central bank, we are a going concern. We have liquidity. And we will continue to run monetary policy guided by our mandate. We do not run monetary policy to maximize our income. Low inflation is a public good. We run monetary policy to deliver low, stable inflation. Obviously, it will have some impacts on our balance sheet. Those are largely accounting issues, and I'm going to turn it to